Our next guest is a hedge fund manager. He is also the co-host of the popular radio show, The Portfolio Doctors, on 1170 AM. Please welcome back to the show one of the nicest and smartest guys we know, Steve Bick.
Steve!
Hey.
He's here!
Hey, Steve!
Whoa!
Yay.
What's up, man?
Oh, I guess not a lot.
I guess, huh? Well, the market has been up and down.
Yes.
Then back up.
Right.
Then back down.
Correct.
Now, we posted something, and we want to talk about global markets today, I think, because there's just so much going on, and I don't even know where to start, really. But we posted something because Carl Icahn said recently through Yahoo Finance that markets are overpriced and earnings are misstated.
Right.
So he's calling for, a big correction. I've seen a couple other people out there, talking head type people, who have said similar things. This market is ready to go down. This
Right.
market is not correct. Is there any global market we can look to that might signal that, or why are people saying that right now?
Well, I think it's more of a macro issue, to be honest.
Okay.
I think that the earnings coming out of Wall Street are going to be bad this coming quarter.
The fourth quarter.
Yes.
Wow.
Well, it's going to start pretty soon, right? They're going to start announcing earnings pretty soon. But it's going to be poor because there's all the headwinds, firstly, of the strong dollar. So if you think of yourself as an Apple, for example, you have to convert a lot of those sales that are coming out of Europe and China back into dollars to report earnings. You're going to have a massive impact from that. Plus, I just think that the whole global environment has slowed down significantly, and therefore there's just not the growth. They're already ratcheting down their earnings expectations.
Wow.
Before we even go into earnings.
So the strong dollar is a bad thing for these companies.
For a lot of the companies, yeah. I think the bigger problem, there's a much bigger issue than that. I think if you look over the last 40 or 50 years, the government and big business, when you go all the way back to lobbying, right? So if we look at the lobby that came on, big business finally woke up one day and said, wow, we can lobby too, right? They started lobbying for changes. And I think what you've seen over the last 40 or 50 years is the playing field has now switched from the small business to big business. It's firmly in big businesses' control. And what's that done is now you've got the large companies like Apple, Microsoft, Oracle, all these multinational companies have really taken over the playing field in terms of jobs and growth.
Right.
And they are going to be impacted by this dollar because they're now global, right? So that the dollar move is going to impact them, which is going to impact the market. Unfortunately, job growth comes from the micro companies, from the small guys. And there really isn't an incentive to start a company these days because you've got all these headwinds of, Dodd-Frank and the laws and legislations and Obamacare. So people are now just going to big business to try and get a job. And unfortunately, here come the layoffs.
Right. And there's nothing you can do about that once it comes. I mean, it's much more difficult after you've been laid off. Once you go that direction, to try to start your own business or get something going.
Well, worse than that, the labor participation rate is its lowest it's ever been. So there's 95 million Americans that just aren't even in the labor force. That could be.
Yeah.
So that's
crazy.
Over 35% of the population in the USA is not working.
That is incredible.
Yes, which is the worst number that's ever been reported. And yet people expect good numbers out of businesses. But there's just not that growth anymore. And unless you're capturing market share from other places, you just aren't growing because the world economy isn't growing.
Right.
So how do you get good numbers?
I don't know. I don't know how they're expecting it. I don't know how we've had good numbers to this point. I mean, for the past few years, there's been some things that have been really questionable out in the marketplace. I mean, the things that are happening in Europe, we've got Russia, Syria, the Middle East, all these different things. Jen, let's go to Facebook real quick. The Carl Icahn story. A couple people were commenting in there. I thought it would be worth mentioning. What do we got?
Well, we asked on our Smarter San Diego Facebook page about the Carl Icahn quote, "Markets are overpriced and earnings are misstated." Rick Montejano said Carl Icahn is a blowhard and got really into it, virtually into a fist fight with another guy on Facebook.
Yeah, if you want to troll that string, it's pretty interesting.
Yeah, they really went at it. And Lewis Williams said, "I need to rebalance my positions anyway. I feel like I am spread too thin." And I think a lot of people probably feel like that.
Well, it's an interesting concept, though, because spread too thin, I mean, usually if you're spread thin, that means you're well diversified, right? And that should be a good thing.
Not necessarily. Too thin could also mean that you may be overly exposed. you know, and diversification to me, and I've traded everything, you know me, I've traded everything.
Yeah, I do, yes, this guy.
But diversification, I've lived through pretty much every crash in modern history, right? And what you discover, particularly I think the biggest one was in 2008. If you look back to 2000, the crash that happened then was more related to the NASDAQ and to stocks. I mean, real estate was unaffected, and there were certain ways you could sidestep the crater, right? This last time in 2008, the whole idea of diversification is certain of your positions remain strong or go up while other stocks are going down or positions are going down. So you have an offset, and your portfolio as a whole hopefully keeps growing, right? In 2008, everything just went down together.
Everything was down.
Everything. And you know what's interesting, because bonds weren't, okay, the price of bonds, of course, was going up as they were lowering interest rates. However, if you had bought the bond ETF or a bond mutual fund, they got crated because they were just lumped in with stocks. And recently, when we had that meltdown in the market, there were days where there were certain ETFs that were 30 to 40% lower in value than the underlying assets of the ETF.
That's amazing.
Because people are dumping it as a stock. They're not looking at, they couldn't rebalance.
That
ETF,
much?
Yes, it was ridiculous. So an ETF that should have been valued at 70 was trading at around 45 to 50. Now, it was a potential buy opportunity unless you believe that those other assets are going to continue to fall. But it just shows when you have this type of situation where there's a portfolio and a pooled asset and people are just dumping it because it's a stock, there's not enough time for the people behind the scene in the ETF to rebalance it fast enough to be able to level it out and actually match the asset value.
Are you saying that there is no way to be diversified?
Pretty close. Pretty close.
Oh, that's depressing, Steve.
It's very, very difficult. I mean, you think 08, right? You had housing came down, stocks came down, gold got pummeled, bond prices, you know, the bond ETFs and that got pummeled. There are ways. I mean, obviously, you can have something that truly is a hedge, right? So you can invest in things that are the triple negative on the stock exchange. You could buy those types of Direxion type investments, which are triple bear or something like that. That would be a proper hedge. People don't like to do that because they don't like to ever see any part of their portfolio losing.
Right.
But a true hedge means that in good times it's losing money, in bad times it's making up for some of the differences. But I think the overall concept of diversification, which is some small cap, some large cap stocks, some mid cap, a few bonds, and sprinkle in a little bit of maybe some properties, it just doesn't work. When it's going down, that's all going down together. Now, what it does offer is the opportunity to buy, right? At some point, when everything's been washed out. You think back when the S&P was at 667, I think was its low, and that was a great buying opportunity. Of course, you know, there's blood in the streets, right? So it's really
tough to pull the trigger.
It's tough to pull the trigger, and that's what you have to realize, that you've got to be able to have that stomach to go in, which a friend of mine did, and he turned 200 grand into 5 million. So it can be done, right? It's just a matter of being ready and not being over leveraged. I think if you want to diversify in this environment, get out of all leverage, because that's the part that's going to kill you.
You heard it here first. Our Smarter San Diego. That's Steve Bick. Check him out, theportfoliodoctors.com and the Portfolio Doctors radio show on 1170 KCBQ. Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else, commercial free.